Hi, I'm Tim Steffen, Director of Advanced Planning here at Baird.
And I'm Heather Osborn, Director of Wealth Planning. Jason Trennert and Dan Clifton, our colleagues from Strategas, are going to provide us with a fiscal policy and financial market outlook for 2023. And then Tim and I are going to come back and provide some tax and planning strategies to consider into the new year.
Hi everyone, I'm Jason Trennert, Chairman and Chief Investment Strategist at Strategas, Baird's investment strategy arm. And today I thought it might be a good idea to go through some basic ideas that we have about the markets and the economy as we head into 2023.
What is your outlook for inflation and subsequently Federal Reserve policy in 2023?
Well, as far as inflation and Federal Reserve policy in 2023 are concerned, I unfortunately have a little bit more of a bearish view perhaps than consensus. I don't know if we would quibble with the idea that inflation has probably peaked, but we're also of the view that there are structural elements of inflation, whether it's tight labor markets, whether it's the energy markets, whether it's deglobalization, that could keep inflation higher for longer and certainly higher than the Fed's target of 2%. I think as a result, we tend to think that the Fed may finish its tightening program in the first quarter of next year, but it's likely to leave rates quite a bit higher for longer, perhaps, than the equity market believes.
What is informing Strategas' below consensus outlook for corporate profits in 2023?
Our forecast for below consensus profits in 2023 is largely driven by the fact that we think that the chances of a recession are quite high next year. That's largely due to an inverted yield curve, both on 2s and 10s and 3 months and 10-year treasuries. Also due to our view that corporate profits are going to be under pressure because of persistent wage gains. So those two elements are going to make it hard to see growth in earnings next year, and we're looking for earnings to be down about 10%. In a typical recession, the average recession, earnings are actually down 30%. So it's not quite as bad as what might one expect normally, but it's quite a bit lower than the street is looking for next year.
How are you positioning your firm's portfolios to reflect your outlook?
Well, we're positioning our portfolios a lot more defensively than we normally would, given our expectation of a recession in the next 2 years. So we're holding more cash than would normally be the case, and our sector weights tend to be quite a bit more defensive. So we're overweighting healthcare and consumer staples as an example. We also have an overweight in energy, but that's really driven more by structural issues in the energy market than any sort of cyclical call. But largely, I think whatever sector an investor is looking at, we believe that they should be focusing on companies that are generating cash flows and profits. This transition from QE to QT, in our opinion, means that companies that can fund their own growth, that are self-funding, are going to have a decidedly strong advantage over the next couple of years. But unfortunately, the tide is going out as far as the cheap cost of capital is concerned.
What is something you are watching that you feel is currently being under-discussed?
Well, one of the things I am looking at pretty carefully is government spending, certainly as it relates to inflation. And I think one of the things that's sometimes missed in discussing government spending is that a good portion of it, over 60% of it, is indexed to inflation. So Social Security, as an example, the cost of living adjustment was 8.7% for this fiscal year. Same is true for Medicare and Medicaid. So despite the Fed's best efforts to tighten, in a way, they're going to be fighting the federal government or federal government spending. So we're watching that pretty carefully to see how difficult it might be for the Fed to bring inflation down. I think we're also watching profit announcements and earnings revisions very carefully as well, because thus far the pace of growth in earnings has slowed. Expectations for earnings has slowed quite a bit. but there haven't been really much in the way of layoffs aside from Silicon Valley. And we're really watching the profit projections pretty carefully to see whether more layoffs are going to be in the offing. Well, thank you all for your time. I'm going to pass the baton to my colleague Dan Clifton now, who will talk about all things Washington. Thanks a lot.
Hi, I'm Dan Clifton, Head of Policy Research at Strategas. I want to just take a few minutes today to answer some of the questions that our clients are most frequently asking us about for the outlook in 2023.
What happened in the midterm elections, and what does that mean for governing in 2023?
The 2022 midterm elections had a very bifurcated outcome. The voters of this country removed the party in power for the 8th time of the past 9 elections. This is the most political volatility in the United States since the end of the Civil War. At the same time, these voters gave the Republicans a razor-thin majority in the House of Representatives. The Republicans will start off in 2023 with just a 5-seat majority, their lowest or smallest majority since 1854. This is a very similar majority as the Democrats had over the last 2 years, again, a 5-seat majority, indicative that this country is as close to a 50-50 nation, and we just keep passing the baton back and forth in these razor-thin majorities. That argues for not much getting done in 2022. 2023. We anticipate that you'll see the Democrats in the Senate passing messaging bills that are unlikely to be signed into law. At the same time, Republicans in the House will be passing similar bills on energy and immigration and other key policy issues. When you pull all that together, the only legislation that is likely to pass in the beginning of the year will be legislation that is must pass. These are legislation that deals with the budget and deals with the debt ceiling, as those have to get passed and will require compromise between the two political parties.
Why will 2023 bring the return of deficit politics, and what are the ramifications?
As we head into 2023, we're going to start seeing a meaningful deterioration in the U.S. budget deficit. Tax revenues will begin to slow as the economy is beginning to slow, but more importantly, the net interest cost on the debt is set to rise and rise pretty meaningfully over the next few years. This is because the Federal Reserve has been raising interest rates to stamp out inflation, which is going to make the cost of servicing the U.S. debt much more expensive. This is going to come at a time where Congress will be forced, somewhere probably around July, where they'll have to raise the debt ceiling. The Republicans are going to demand some level of spending cuts based on the spending that was done over the last 2 years in exchange for raising the debt ceiling. The Democrats, who did a deal very similar to that in 2011, will be unlikely to do a deal this time around and will resist that. And so there's going to be a bit of brinksmanship on these fiscal issues in the first half of 2023. Ultimately, we think that there's going to be a compromise, and that compromise may center around some sort of commission studying the rapid increase in federal spending as well as entitlement spending and how to make those programs more solvent for the future.
How do you see deglobalization, one of Strategas' highest conviction themes, evolving over the course of the year?
While the U.S. remains highly polarized and a 50-50 country, the one item that is bipartisan in Washington right now is bringing home the supply chains due to a greater national security risk aiming from geopolitical events in Russia and China. What we're likely to see is a continuation of the policies that we've seen over the last 2 years over onshoring. This included paying the semiconductors $75 billion to bring their factories home to the United States. And over the course of the next few years, you'll have 8 new semiconductor facilities being built into the United States. Congress, on a bipartisan basis, is now looking at other industries that are critical to the supply chain to start bringing home to the United States. And most notably at the top of that list is the antibiotic industry and more broadly the biotech and pharmaceutical industry to ensure we have proper medications and are not subject to supply chain disruptions. Ultimately, we're seeing more and more companies wanting to be located closer to their end customer, That doesn't mean just the United States. It means being located in other places that they're selling. And we're likely going to see more companies starting to say, let's locate in the United States, let's create American jobs, and we expect on a bipartisan basis, Congress to continue to push legislation to incentivize these companies to locate here closer to the American worker. Thank you for your time today. As these issues begin to develop in 2023, we'll be sure to keep you updated. We wish you the best of luck. Feel free to reach out if you have any questions. Thank you.
Tim, we just heard our friends from Strategas provide their fiscal policy and financial market outlook for 2023. We've seen a fair share of turmoil this past year, but as you and I are well aware, turmoil can also create planning opportunities.
That's right, Heather. As investors, we've been pretty spoiled in recent years with positive market returns. And even the pullbacks we've seen have been relatively short-lived. But in a year like 2022, where it seems like there are negative returns everywhere we look, it can be difficult to find the silver lining. Unfortunately, years like this do provide some planning opportunities. To begin with, losses in a portfolio can provide some tax savings, especially if they're used to offset gains that may have been realized elsewhere. And even if you don't have gains to offset with those losses, there can be value in banking those losses this year and carrying them forward to use in a future year. When we have years of significant volatility like this, it's very likely that your portfolio has drifted from your target asset allocation. Rebalancing a portfolio back to its target can be difficult to stomach in years when the market has performed positively because of the tax costs associated with selling things at a gain. But in a year like this, the tax cost may be much less when it comes to rebalancing. Another strategy to consider is a Roth conversion. Converting dollars from a traditional IRA to a Roth IRA does trigger a tax liability, but at today's lower asset values, that tax cost could be much less. And therefore, any market recovery could be captured inside of a tax-free account. And lastly, today's lower asset values can create a real wealth transfer planning opportunity, as additional shares of stock or mutual funds can be transferred to individuals and other heirs with less risk of running afoul of the gift tax limitations.
These are all really great planning tips, Tim. And the other big topic that dominated 2022 was that of inflation. And while it remains to be seen how this will play out into 2023, we are aware of some of the implications that this will have on planning. Can you shed some light on some of the impact it will have in this next year?
Sure. The broadest impact we'll see from a planning standpoint will be to our tax data. The tax numbers are adjusted each year for inflation, but because of the significant inflation we saw in 2022, the adjustments for 2023 will be very meaningful. For example, we just talked about gift tax limits a moment ago. For 2023, the annual gift tax exclusion will increase by $1,000 to $17,000. This is the second consecutive year we've seen such an increase, the first time that's ever happened. From a broader standpoint, the amount of income subject to the various tax rates will be increasing thanks to the higher inflation. So while the tax rates themselves will not be changing, the amount of income subject to each of those rates will go up dramatically, meaning more income will be available to be taxed at the lower rates before reaching the next bracket. On a related note, the standard deduction will be increasing in 2023 by nearly $2,000. Roughly 90% of all taxpayers use the standard deduction rather than itemizing, which means for those taxpayers, it's an additional nearly $2,000 of income that will be exempt from tax in 2023. For retirees, Social Security benefits will be increasing by 8.7% for 2023. This is the largest increase in benefits we've seen in more than 40 years. So while inflation did create a lot of problems for taxpayers in 2022, it does create some real planning opportunities for 2023.
Well, thank you, Tim, for highlighting some silver linings in what was otherwise a pretty rough year for many, many people. Hopefully these planning opportunities can help us kickstart into a better 2023.
For sure, and while it's important to be aware of some of the changes that might be coming in 2023, we don't want to lose sight of some of those tried and true strategies that have worked so well for us in the past. So Heather, as you're meeting with our advisors and clients, what are some of the planning strategies you like to focus on?
I like to begin by learning about our clients' fundamental cash flow issues. How much are you saving? How much are you spending? Many savings plans begin by maximizing retirement plans. Contributions to these type of plans adjust each year for inflation. And as we heard from Tim, these amounts are going to increase significantly into 2023. Another thing to remember is that in the year you turn age 50, you'll qualify for an additional catch-up contribution. This can be a great way to supercharge your overall savings plan. Most plans offer both traditional and Roth options. There are pros and cons to both types of plans, so be sure to weigh which type of plan is best for you. Another place to begin saving is a 529 plan, which is a great tax advantage vehicle for future education expenses. Doing this via automatic deposit can be a great way to maintain automatic savings going forward. Spend some time at the beginning of the year reflecting on your goals. Maybe it's retirement, that trip of a lifetime, a wedding, or a new home. Visualizing and writing down your goals can ultimately make your savings program all that more successful.
So it seems simple, but most good planning strategies come down to saving more and spending less. I'm sure there's other things you like to focus on too, Heather. What are some other things we should be reminding our clients about as we head into the new year?
Absolutely, Tim. One area I encourage our clients to review periodically are their estate plans. All too often, these plans are set up as a set it and forget it basis. And it's really important to keep in line with your overall financial situation, your family circumstances, as well as where you might even live. And so it's important to review these to keep up with the changes over time. Also, be sure to review your insurance, not just life and disability, but also home and liability as well. Perhaps your home is increased in value, or maybe you're an empty nester, retired, and you don't require the same amount of insurance you did during your income producing years. It's really important to review these changes over time. And don't forget your digital footprint that seems to get bigger and bigger as each year goes by. Be sure to reset your online passwords and enroll in an identity theft program that can monitor and stop any activity before it might become a problem for you.
Those are all great suggestions, Heather. Thanks. So as we head into the end of 2022 and begin to look forward to 2023, use this time to take stock of where you are, both personally and financially, and make sure you're taking the steps necessary to meet all those financial goals you've set for yourself. Be sure to reach out to your Baird financial advisor, as their role is to help you stay on track and make sure you're meeting all those things you intend to do during the year. From all of us here on Baird's Wealth Planning Team, we want to wish you happy holidays and best wishes for the new year.